This is episode 115 of the Steady Trade podcast with your hosts, Tim Bohen.
I like this. You're going to try and convert me.
And Stephen Johnson.
It took us about a year and a half to develop and about another year and a half to follow.
Today, Stephen once again tries to convert Tim to the joys of short selling. And this time, he's using 6 rules that it took him about a year and a half to develop and another year and a half to follow.
It took us about a year and a half to develop and about another year and a half to follow.
Yeah, I know, we already said that. But he's fresh off another spiritual adventure to Thailand. And like Tim always says,
I know that every time you go to Thailand, you come back enlightened. I think you've reached the next plateau of enlightenment with these trading rules.
And you get to hear them right now.
Welcome to the Steady Trade podcast. I recently turned a $600 account into a $3,500 account with one setup following 6 rules. If you follow the 6 rules to a T, Tim Bohen even agreed you can do the same. You can have the same results. So let's get into the episode and check out the rules.
Hey everyone, Tim Bohen here. Really appreciate you listening to the Steady Trade podcast. I have a great time doing it, really giving back, and it's a true passion project of mine. But if you really want to get into the nitty-gritty of trading, in StocksToTrade Pro, it's a mentorship program that I do twice daily webinars every single day of the week. Never miss a day. Market open, market close. And I think it is the best way to really speed up that learning curve. And the best thing about it, and this is something that I'm truly, truly proud about, is we built an amazing community in StocksToTrade Pro. We have a chat room, traders in there all day long, new, intermediate, advanced, young, old. It is an amazing community, and I think by working in these twice daily webinars with the chat room, with the community, with StocksToTrade, it is one of the best ways to become that consistently profitable trader.
Welcome to the Steady Trade podcast. Jeevan Staunton here with Bim Toen. Did you see what I did there?
That was tricky. Yeah, that was tricky. I like it. Yeah.
I had a thing about it. It was weird. I'm back from Thailand. Tim's back from America, but I think he never left. And we are talking about NBY. It was a successful trade I had on July 29th, but it was a tricky one. So with it, I want to run 6 rules by Tim Bohen and the audience. And it's my 6 rules to short a stock on its first green day.
Oh, okay. So you're gonna. I like how you prepared. So I appreciate you bringing the ammunition. So you're gonna try and convert me. I didn't really know. Just so the listener knows, this was kind of Steven's. He was the producer of this episode, and I wasn't sure exactly what we were going over today. But I like this. You're gonna try and convert me to believing in a good time to short a first green day.
Yeah, and I don't really want to.
I like it.
I don't really want to share this strategy because it took us years to develop. It took us about a year and a half to develop and about another year and a half to follow. I did blow up my account on RKDA, but it's not because I didn't follow the strategy. It's because I left shares in and I thought I was out, and then I went on the drink in Thailand for 2 days, and then when I looked back, I blew up my account. So
hey,
it's nothing to do.
At the Steady Trade podcast, we're always about, helping you get 1% better, refining your trading rules, tweaking things. And yeah, hey, Stephen and I think, we've got a lot of good material to give to you. And I think that Stephen might have just laid the most golden of golden trading rules. Never stay short a low float stock and then fly to Thailand to get drunk for 7 days. I think that might be the greatest trading rule of all time.
Honestly, what happened was RKD was risky, and I was like, I shouldn't take this, but it looks slightly weak pre-market, and it should wash out, which it did. And then I had the ping button to say, oh, you covered your shares, but I forgot that I had another 1,200 in, and then I went on the drink for 2 days, looked back at my account, and I was like, where's all my money gone? I was gutted. I was totally gutted.
But this is what I like about today's episode. In your point on RKDA, and again, I appreciate the honesty that you're willing to openly admit that mistake. And I think it closes the loop well, because listen, I read a quote, and I got to look it up who said it, but it was I think he was either one of the turtle traders or one of the market wizards. And his quote was, listen, I could print these rules out in the newspaper, and if people don't follow them, it doesn't matter. So that's why I'm telling you, I don't think you have to be worried about this strategy that took you 2 years to employ, because what we have seen, and that's why we get so many epic short squeezes these days, is people just refuse to follow the rules. So please, as we get started, if you want to be in that 10% that don't fail, okay, 90% fail because 90% fail to follow the rules. So please blatantly steal what Stephen is about to present here and stick to it, because you'll find out, just like what he did, it was completely outside the rules, and that's how he blew up his account. You follow these rules, you minimize your risk.
The thing with me is, though, like, I've got to the point, I was a bit sad at first, but I've got to the point with trading where I have the rules and I can follow the rules, and I can grow my account from $600 to $3,500, 500% in 2 months. I've only got one rule left to follow. It's don't get pissed anymore. That's the only rule left, and I've clocked it. But anyway, let us run.
Before we start, I want to make one point, because I don't want to jump over what you just said. What's neat about what Stephen just said is, he's got over 2 years in this now. And yes, guess what? Last week he blew up another account. It happens. It happens to everybody over and over again. But what I love, Stephen, I love where your mindset is at, because you've now, and again, I get it, and the listener might be, how many times is it going to blow up? But you now know that you have that tool set to build an account. And if you can just, don't go to Thailand and get drunk for a week, but you're like that carpenter with tools, and you can show up at a construction site and make money now. No. As long as just like the construction worker that gets drunk and falls off the roof, we just got to avoid those situations. So,
no, I have full confidence now. I have the skill set, tool set, even the mental ability and discipline to grow an account over and over and over again for the rest of my life. It's just watching me personality, because I'm a bit reckless and a bit crazy, and just refining the final thing of keeping off the drink. I'm day 2 sober right now. Let's see how many days I make. But no, I'd love to get your perspective on these rules. I don't really want to give them away, but I'm at the same time, because I know a lot of people are like, oh, you've worked so hard to develop your strategy, and other people should work hard too. But I think stuff it. Let's give this away.
And I still say, listen, and I know this might sound,
you might not even like it,
or it may sound like I'm some old curmudgeon, but listen. If we have 100,000 listeners of the podcast, whatever that number is, probably 5 people will follow these rules. And I'm sorry to the listener. Listen, I love each and every one of you, and I appreciate you watching these videos. But you've been in enough chat rooms. You've been on Twitter. Maybe 5 people will follow. Maybe 5 people will steal your system. So,
and you know why? Because these rules, shorten a stock on its first green day. These rules are the hardest rules to follow. All the rules. It's not so hard to like cut a VWAP hold in the afternoon when it's not working out. But when the stocks are moving fast, these are the hardest rules to follow. So let us dive in. Let us share the screen, and we'll go through the 6. And I'd like to hope that you'll be on board with them. You can see this second screen, right?
Yes. Yep. I got you. Yep.
Okay, so basically, just to give some context, this is NBY. We can see where this arrow is here. Can you see the cursor okay?
Yep.
We can see it ran on 50 million volume, had a huge day, making it a former runner from 0.5 up to 3.5. Gapped up the next day, which they typically do, and then it crashes because it goes from 50 million to 30 million the next day. It doesn't have enough volume to kind of keep the people who bought on the first day interested and move again. And once it starts to tumble, it falls. Once what's the phrase? Once it rains, it pours. And that's kind of what it's like with this.
Well, and and this is a classic, what we would call a junk stock. I mean, this is not this is once the momentum shifts, all the longs are like, get me the hell out. And then the shorts are all coming in. So all you've got is selling. When it fails to continue the next day and breaks down, all you have is selling, because everybody that held from the day before is selling, and the shorts are selling because they're, they got to sell first. And just who's going to buy this piece of crap on a day two? So on fading volume. Yep.
Yeah. So, I mean, it's a 12 million, I think, no, it's a 12 million float or a 19 million float. I can't remember which, but it's an under 20 million float. So it's traded all of its float on the way up and all of its float on the way down, which basically means everyone who is in this stock who is long is underwater and looking to sell at the next push. And then this is the next push. This is on the 29th, and this is what
what you're doing there, and again, if you're listening on iTunes, be sure to check out our YouTube. We'll try and talk you through it as much as possible. But what Stephen has showed here is rule number one. He has shown that this is what we could traditionally call like a one and done type stock. Okay, so so historically, about a month before, the stock spiked and failed. So as I always say, I stole it from Mark Twain, I believe, history doesn't repeat, but it rhymes. So he's checked the first box. He's got a one and done stock. This is what you want to look for a chart pattern for something to short. So,
okay,
I didn't even see it.
Rule number one: if it is run before, it must be forecast. And when I say forecast, generally a stock, what it trades pre-market, it'll generally trade between 9 and 12 times that. That's not by any standards legitimate, but most of the time it'll trade 9, 10, 11, 12 times the stock. So if it's run before, it must be forecast to run less volume than the day in question. Now, the reason that I'm saying that, it goes against the golden rule that if there's the full float or underwater who went long, the next time it pops up, which is here, you don't want more. I mean, if you've got more than 50 million volume, if you've got anywhere near this amount of volume, you'd expect that it'll do something similar. So you want significantly less. So when the stock does pop up on less volume, you've got a bit of selling pressure out, because people at the open are all trying to get out who've been in long from that previous time.
Yeah. So this is that's the bag holder exit. So and again, I love where you're going with this. So you now know that when the stock gaps up, on lower volume, that basically, that's giving the bag holders the exit. And if you don't have, I use the term ridiculous volume, where it's that projection, that Stephen's projection, where it's going to eclipse if this thing was projected to trade 100 million shares, different story. But it was probably projected to trade a handful, maybe 5 million, et cetera. So,
yeah, and I mean, you can bet on this day it would have traded a good 4, 5, 6 million pre-market on this day. So on this day, I remember it was trading about 300, 400,000, 500,000, and you just know that it's never going to have the same oomph that it had on this day, because it just doesn't have the bias to take it up. So just rule number one is if you're going to short the first green day, and it's had a big green day in the past, it must be forecast to run with significantly less volume than the first green day.
So my comment is I love rule number one.
You love rule number one. Excellent.
Yep. And I want to make this point before we move on. I think this is something that many newer traders overlook. They look at the price, they look at the chart, which is great, but I don't think there's many. Now, I have no way of proving this theorem. I don't think there's many newer traders are out there doing this volume projection idea to see, okay, is there enough interest in this stock? Because that's what volume represents. Okay, volume represents eyeballs, demand. Yep. And so I love your rule, because you're looking at like saying, hey, this thing ain't gonna do, barring some news in the afternoon or something, this thing's gonna trade nowhere near what it did the last time it spiked.
And you can see it on the tape as well. If it's got these crazy, not even like, do you know, you get the ladders as the ladders go up. If it's just got these crazy up spikes and it's holding them, then you can tell by the tape as well. But if it's just dwindling along and it's almost going to crack, and then you can tell by the tape, but it's more accurate to do a volume projection. But point 2 and 3, which kind of go together. Point 2 is one of the rules where you can short. If it has run before, you should never, ever be in more than a quarter size. You would probably say no size at all, or a third, for the risk for it to be, just in case it runs unexpectedly again. You do not want, even if it looks weak pre-market, you don't want to be in more than a quarter or a third size, because if it does rip at the open for some reason, it's a trick, it's an institution playing a trick, it's a large buyer ripping shorts heads off, news comes out at 9:31, you've got to be very careful. So you want to be looking really for the double tops or risk off the...
Wait.
Okay. You want to just go to...
I thought we were a team. What happened?
Okay, go on. Let's go. So let's just bring up the entertainment.
You go to Thailand and you totally forget about me.
Okay, no.
Thailand, that you're no longer willing to work with me on this podcast.
Not a lady boy, but let's just go to this one. Okay, so here's NBY. You can see the volume is dwindling, but you do get that spike. It goes from 115 to 145. That's a huge jump. And it holds it. That's a red flag. But what's your opinion on that?
So back to number 2. No, I love it because I just want to. I love that as a rule. You're slowly converting me here, but man, this goes to the newer short sellers out there. Listen, short these first green days if you want, but if you're doing it with 80-90% of your account, or if you're doing it on freaking margin, please listen to Steven, okay? You don't go in full size, especially on margin, at 9:15 a.m. I mean, that's why so many people blow up doing this. Take that, instead of 1,000 shares, take 200 shares. I mean, if you got a small account and you make 50 cents a share or $1 a share, that's $100, $200. That's really good on a small account. So please, if you're shorting that green day, don't do it full size, and please, I beg you, don't do it on margin.
No, and honestly, and that was how I managed to grow my account 500%. And it's because the main difference between me trading last year and this year was I would be in a heavier size pre-market, then I'd be adding. And some days I'd blow up, and other days I'd make a smallish profit. I'd make like 10%, 12%. But if you just wait for the open to short the more of the double top, you're getting you're taking the full piece of the move, and you're taking 30, 40% of the move, or sometimes a 30, 40% gain. And your risk is only like a couple of percent on the double top, which means you can significantly grow your account, where if you're trying to make up for lost gains when you are too heavy pre-market, then you're just going to blow up your account and not get as good a risk reward. And just that's the way it works.
What was I want to read rule? I see the chart.
Yeah.
So I want to read rule 3. What was the text?
Rule 3 is look for the double tops and risk off the initial high of day. If it breaks the initial high of day after 9:30, it will likely run.
So again, love this rule. If if you're a StocksToTrade Pro member out there, you hear me talk about this dip and rip type setup every single day. I mean, if you've listened to the past podcasts, that basically one of my favorite setups is the opposite of what Steven's talking about. It's that stock that spikes, dips, and then breaks that high. Now, that's one of my favorite long setups. But what Steven's saying is similar setup, but you're looking for that spike, then the respike, and then the fail. Or I hear the term like stuff move a lot, where people talk that it stuffed into the high of day, and that's exactly it. So now that you've ideally got a good entry, because twice it failed to break the high of the day, and then you also have a clear exit. Because listen, if you stay in this stock as it breaks the high of the day, the third attempt, then you're just an idiot and you're asking for disaster. So I love this because you get the double top, and then if it gets there again, okay, I'm out. I can't stay in this.
Yeah, so basically the way I played this is around this period of time, there's no volume at all, there's no interest, it hasn't really done anything. But then when you get this push, this is when it hits everyone's scanners. Yep. It's hitting everyone's scanners around 9:18, 9:20, because it's just moved 9:15 to 9:45. It's up like 20, 25% on the day or something like that. You don't really want to be getting in anywhere around here because it could just go to 2 instantly. You need to be a bit more careful.
Today, DPW, we had a stock today.
I heard about it.
It went up 500% in pre-market. If you're shorting that move, good luck. So
I know people think I'm crazy because I was getting lots of tweets by people saying, "I hope you're not in this short, Johnson." I was like, "No, man, I'm taking a few days. I've just got back from Thailand." But so basically, you want to be careful this doesn't go 500%. But like when it gets near the open and it's struggling to make that kind of new high of day pre-market, this is where I took like about a quarter, a third to think, all right, it might just hit this higher day and drop out. So I took about a third in there just to think that it could wash out. And then after that, I shorted into the spike. So I probably had another entry roughly here, thinking most times you'll see a stock spike 7-8% at the open before it pulls back. And if it doesn't pull back much, or if it pulls back a little bit and rips again, it's just too strong and it's away.
Yep.
And then it pulled. So this morning spike, this is your high of day. For me, it pushed, little consolidation candle, pushed again. Then it had its pullback where it comes back down here. Now, if it manages to consolidate like this and then rip through, then you've got to be out. If it breaks this point at any time, you've got to be out.
Yeah, so I was that VWAP hold pattern into the afternoon if it tracks sideways. Yep.
Yeah. So I mean, I was a third here, and then I was a third into the spike, and then I was a third as it pushed a second time. Now, if it pushes through here, I might give it a couple of seconds above this line, but I'm like talking seconds. And if it just keeps on going, I'm immediately out because all the other shorts are going to cover, all the professional shorts are going to cover, and all the longs are going to buy. And it can easily jump 5-10% here, and you don't want to be caught in that 10% rip. But as it happens, it comes all the way back down. So this is how I'd play position size. This is how I'd have kind of rules to look for the double top and risk off the initial high of day. If it breaks that, it will likely run. This is what I'm referring to.
And I like your scaling in as well. Now, I love it because you're taking that feeler position, you can call it. Now you might end up burning some day trades. That's the only bad part, because if you're stopping out on those feelers, but that's part of the game. If you're under the PDT and you're shorting early, you got to be willing to burn those day trades to stop out because you can't overstay in these things. And I love the way you approached it, where you let it spike early, pulled, then you put that feeler on, and then you add it into the parabolic move, I guess you would call it. So.
Yeah, and the crazy thing is, though, when I grew my account from 600 to 3,500, I was just doing the same thing over and over. I was just doing this over and over and over. This is the only setup I took, and I did the same thing with the same setup, with the same rules, over and over and over. And it was just like too good to be true until I got drunk in Thailand. But I'm just going to do it. But I'm just going to do it again because I know how to do it. But the only other criteria is generally, this was a biotech, only look for biotechs. And the reason that I only do it with biotech, and if it's quiet for biotechs, I just don't trade. And like sometimes I will, like if it's like a retail or something like that, I'll stay away from commodities. But if it's retail or technology, like sometimes I'll try, but I'll be so careful because a lot of the time, if a retail stock's up or an online kind of thing's up or it's something else is up, which probably is a hot sector, the two unpredictable. You can't guess what they're going to do.
And I like that rule as well. Listen, the reason we love hot sectors so much is people just lose their minds. So I say rule 4 is great. Avoid the hot sector. If it's, if weed stocks are going nuts, if crypto's going nuts, if cloud computing, social networks, avoid those. Biotechs always spike, and a lot of them spike and fail. So I love this rule that, and I see you talk about this from time to time where you're like, well, this stock is my pattern. It's doing what I want, but it's not a biotech. And listen, we love biotechs because they run, and shorts love them because 99% of them are jokes, will never make money, may never even have a product. So they're great for those spike and fails. So.
Yeah, and just to add on to that, the reason that none of them will ever make money is because these biotechnology companies, they're trying to develop products, and 99% of them never do develop the products, but they need to keep on making money to continue trying to develop the product that they won't develop, where an actual company might have some good news that has half a chance of turning it around, but a biotech, it's just much less likely, and that's why I love them. Number 5, judge the float against the volume to see how many are underwater. We touched this. So if it looks like in the daily chart, everyone's underwater, which we talked about before. If it's only traded 500,000, you can guess at the open, most are going to sell because most are already underwater. So I think we've covered that.
Because that, yeah, and just to clarify to the listener, because that secondary spike, and again, if you're listening along, definitely check out YouTube. But Steven showed, about a month before, the stock spiked and failed on much higher volume. If you don't have that volume, if you don't have those buyers, odds are, okay, that's why you have to have a stop. But odds are, if there's not more buyers, well, not the same amount or more buyers a month later, there's not enough volume to support the spike, and odds are it's going to fail. So,
yeah, and that's always the case, though. You think, like, if the stock spiked on 50 million, and it only looks like it's going to trade 5 or 10 million the next time it spikes, it's just not going to run. It's just not going to, because people are like, well, if it took 50 million to run the last time, it's not going to run on 10 this time when it's a significantly lower stock price and the chart's significantly downtrended since. It's going to take more. Like if you look at the weed stocks as well in the weed sector, it's like if it's ran before, people are going to think it's going to need an even bigger move to go higher.
And we've seen that with the weeds. The last year, they occasionally get going, but the volume never comes. And every time for the last year, they've all been one and dones or maybe a couple days, and then they fade back because we can't eclipse the volume from like 2015. And then I think 2017 was the last time we kind of had like a real run. And that's a great point. There's not enough buyers to push it to those levels again.
Yeah. And that's why all the stocks, like Tim Sykes said, all the stocks become like these bouncing balls that have these dead cat bounces. But occasionally, like one goes a bit higher and a bit higher and a bit higher and a bit higher, and then all of a sudden.
But the point is, when that one comes, when that one comes, it's because it's trading. It's like RKDA, and it's trading 60 million shares. So I think the biggest takeaway for the listener is please write down and focus on Steven's rule number 1. I just don't think enough people are even paying attention to that. They look at the percent gain, they make fun of the news, but they're not even paying attention to the volume, good or bad. So.
And like this number 1 rule is number 1 for a reason, and it's because it's the most important rule. Because you don't even need to, like, it's better if you do, but like you don't need to put that much emphasis on SEC filings, if any. You don't really need to. You should look. Well,
especially in biotechs. That's the beautiful thing about biotechs is it's basically pointless to read the SEC filings because it's a horror show. Every biotech SEC filing will turn your hair white. So that's the nice thing. You basically don't even need to read them because it's all just a disaster. So.
Yeah, and in terms of looking at the news, you don't really need to look at the news. You just need to, look at the news or look at the profile of the company and just make sure it's not cancer or children.
Yep.
Because the cancer and children are generally the only two that run. And if it's not cancer or children and it follows these rules and you're not shorting pre-market and you get that double top, then it's a very solid strategy to consistently build profits. The only final checkpoint is how and when do you get out? And it's generally watch for because a lot of these biotechs, if it's a quiet day or if the news is good, they will wash because people who are underwater from a previous time will sell in the morning, and that's why it drops. But if the news is good, it can kind of trend back. And a lot of people will be like, oh, you shorted this stock and it's up here now. I'm like, yeah, well, I shorted it because the people who went it from when it downtrended, pushed it down, and the shorts always short biotechs in the morning. Like, I see the patterns, so this is why I do it. But they can come back. So you've got to like think when is the right time to come out of it as well. And if I can just bring up this next chart, 1 second. If you can see how you get this double top and then you've got this downtrend. But the minute that you see this arrow here where you've got this higher low, I'm out on the higher low because I don't know if this is going to, on this time it comes to VWAP and rejects again. But once it changes trend, I'm just out because I'm not going to risk it coming to VWAP, testing VWAP and coming back up. And whether I could have got a better price and got out in the 120s when instead I got out in the 130s, ultimately, if I just thought, oh, I risk this high or low, so I'll just risk this high or low. Then you risk the next high low, the next high low, and before you know it, it's up in the 150s. So you've got to get out at the trend change as well.
Yeah, and I think that's a great point. Again, you know, a lot of newer short sellers, they have unrealistic expectations. They hold for too big of gains. You know, listen, Steven, again, as recently as a couple weeks ago, went from like 600 to 3,500 by taking small gains. Don't underestimate how quickly small gains add up. And listen, if you're going to play this short game, you can't expect this stock to go, you know, give the entire move back or go from up 80% to down 30%. I mean, listen, you catch a nice percentage gain move, you take that profit, and then like Steven does, I mean, it's late in Dubai. He takes that profit and he leaves. He doesn't care what the thing does in the afternoon. And maybe you've got a day job. You take that quick profit in the morning, go to work. Who cares what NBY does the rest of the day? But don't get stuck in these grinds.
Nah, I like, honestly, like whatever it's up, like from my experience, you can take a quarter of the move, you can take a fifth of the move. If
See,
it's
a lot of people want it. I mean, a lot of people, oh, it's going red on the day. Well, good luck with that, man.
Nah, but like, and once in 100 times it will, but like, that's once in 100. But like, if it's up 100%, like, and if it's up 100 and then you get a drop to 80, like you want to take that 20%, or if it's up 50% and it gets down to like 37, 38, you just take your 12 or 13%. Like that's 13%.
Exactly.
I don't need more than that. Just take your risk reward, take a quarter of the move, take a fifth of the move of the overall move on the day, and do it every day for a couple of months, and you'll see your account grow. And there's me 6 rules. Have I converted you to short first 3 days?
let's jump back to the rules and let's wrap up here. So I do want to have them on screen. So in my listen, maybe you caught me in a good mood. I don't know, but I agree. Listen, I know, especially like on Twitter, I make fun of if you follow my social, you know, I make fun of these early short sellers all the time because they don't follow these rules. And I think the proof is in the pudding, okay? You just did it a couple weeks ago using these rules, and you said this is all you did. Very simple setup. 6 rules. If they don't line up, you don't do it. So I'm converted, but I also know that out of the 100 people that are listening right now, 99 won't follow, 99 and a half won't follow these rules. So it just doesn't matter. You know, if you're not going to follow the rules, nothing matters. I mean, it's like, so I'm not worried about you giving away this magical system because I know 1% maybe will follow them. So,
but this is why everyone gives out DVDs. Like, how many people give out DVDs and then no one gets any better?
Exactly.
Because no one follows the rules in the DVDs. And that's why you've got to make your own rules, because when you make your own rules, you've got a better chance of following them because they're yours, learned from painful experiences.
Sure. So in summary, listen, my friends, I will still beg you, especially if you're a new trader, please don't short first green day low float stocks. But if you are determined to follow Steven's rules, create your own rules, you know, don't go for those rides, don't blow up your account, have some rules, have a stop loss, and stick to them. I tell you, I talk about this every day in StocksToTrade Pro. Listen, let's say you're 22 years old, or hell, if you're 45 years old, I plan on day trading for another 50 plus years. One day will not make the difference in your account, okay? But one day can destroy your account. In 5 minutes, you can go from $5,000 to $50 in your account in minutes doing this stuff. Yeah. But if you stick to the rules, that can't happen. So please print out Steven's rules and follow them if you're going to short that first green day of a low floater.
Right. And if you can't, and this is what Tim Sykes said to me ages ago, and I just couldn't do it then either, but I can now, but I couldn't then. He's like, if you can't follow the rules, trade a smaller position size. So like you're almost bored. So it's mechanical that you can follow the rules, but don't trade size that you can't emotionally handle.
Exactly.
Because if you can't follow the rules, then you're not going to make money. And I was like, no, I'll just learn at higher stakes. And you can't do that. Like I went through a $600 account and I made $20 and $30. And I'm going to have to do it again. But it's fine though, because it's good practice to follow the rules and then withdraw. If you start losing discipline and start getting greedy again, withdraw and start again and go back until you can.
Well, Stephen, I know that every time you go to Thailand, you come back enlightened. I think you've reached the next plateau of enlightenment with these trading rules. So I do appreciate it and glad to have you back. And to the listeners out there, listen, I already said it, but I'm going to repeat it. Follow the rules. That's the best way to stay in this game. Your number one goal in learning day trading is to stay in the game. If you blow up your account, you're done for another 6 months or 9 months until you can squirrel money away. Follow the rules. Stick to it.
Hi, this is Nathan from San Jose, California, and I like to drive into work while listening to Stephen and Tim on the Steady Trade podcast until I fired my boss and made myself my own. You too can register to win real actual prizes at their website, SteadyTrade.com, and make steady trading a real-time gig. If you really like what you hear, give the podcast a 5-star rating, write a glowing review on iTunes. I did, and this is how we say goodbye in the Silicon Valley. See you next time.